HT Smartcast.
You are listening to a Mint production brought to you by HT Smartcast.
Hi, I am Abhinav Kaul and welcome to this edition of Mint Guru Portfolio. After trying his hand at stock investing alongside his IT job for nearly 2 decades, Abhishek Basumallick founded his own stock research firm Intelsense in 2019. A few months back, he also started Sri Rama Managers LLP, a SEBI-registered portfolio management services company with a friend. Basumallick shared his personal investment journey from being a software engineer to an investor for the special Mint series Guru Portfolio. Let's listen in.
Hi, welcome to Why Not Mint Money, a personal finance podcast where we help you understand basic money concepts and share strategies for you to build your wealth. So let's get started on your money journey.
We'll start at the beginning. If you can give us some background into your family, your education, where you grew up.
So born and brought up in Calcutta, by education engineer, started working in the year 2000 and in an IT company. So, natural progression from being an engineer to getting into IT. And practically the first month, a friend of mine, his name is Gautam Rege, he gave me a book. And before that, I had absolutely zero knowledge about stock markets. Stock markets was something that other people did. You just read a little bit sometimes, if you got time from the sports pages, etc. Because coming from a typical Bengali family, right, there's nobody in and around who was involved in stocks, who were people who were in business, right? So everybody is either a professional, in the family, extended family. So nobody is in business and stuff like that. So no grooming or no idea of the stock market at all. So right after I got into my first job, a friend of mine gave me this book called Rich Dad Poor Dad, Robert Kiyosaki's.
Which year was it?
This was 2000.
Okay.
And I read that book over the evening, night. And I realized that, it was like very hard hitting for me at that time, because I could realize that the only way you can really become financially independent was if you was either, you were a businessman or you were a investor in somebody else's business. There's no way you would become financially free if you were, working for a wage forever. So now obviously business was out of the scene because there was no capital, there's no contacts, nothing. So the easiest and the lowest entry barrier at that time was getting into the stock market. And this was a time when just the online brokerages were starting off, right? So just started off investing. First month salary, I remember, we got, I think, 10,166 rupees. 5,000 rupees, from there, I started with that 5,000 rupees. And I had no idea, right? So no knowledge. So started reading everything that I could get my hands on. So started reading the Economic Times and Business Standard at that point in time. Business World, because I think that was the cheapest magazine that was available. Everything else, if I remember correctly, was 10 rupees and that was 5 rupees, something like that. So started reading Business World. So started getting, initially wasn't able to understand most of the jargon. So, EPS, you have to look up. Luckily, what happened was, again, internet was coming, was available at work. And you could slowly, get to learn. So there were 2 sites which I followed, Fool and Investopedia. Practically read everything that was there, right, to understand, the markets. Started learning. First, I think 3-4 years, most of it went into learning, experimenting, trying. Lucky, because capital was also very limited. We're just putting in 2,000-3,000 rupees, 5,000 rupees a month.
Then one question about the beginning. Yeah. 2 questions actually. So what were the first stocks that you bought?
First 2 stocks I bought. One was Hindustan Lever and the second one was Hindustan Construction. Third and fourth stock I remember was HDFC Bank and Pidilite. And all these stocks, Hindustan Lever I held for 10 years without any returns. I practically sold just before it started taking off. So 10 years, no returns. I sold. It was waiting for me to sell basically. And I sold and it then started doing well. So, all of these gave me that lesson, right? That at a good company need not be a good investment, right? So there are other things than just to look at, a good brand or a good company and then you just invest. It doesn't work that way.
Right. And 2000 was the height of IT bust. So it must have taken some courage to enter stock market at that point of time.
Honestly speaking, I was lucky because I had no knowledge. Right, I did not know that this was peak, this is bust. That I said no knowledge, no money. Only background was conviction was there that okay, over a longer period of time, if you are invested in businesses, that will give you the highest kind of returns. And because you have nothing to lose, and you've read that okay, this is what will eventually get you to nirvana. Is what carried you through in the beginning. Right. If I had got a lot of inherited wealth and I was investing, maybe I would have been a lot more circumspect. But you think about that situation, young guy, 21, 22 years old, whatever money you're saving, you're putting it into the market. So that is not a big amount of money. Maybe as a percentage, maybe for me at that time, it was a decent amount of money. But even in hindsight, what would have happened if I had lost all of it? Nothing. Right. So the opportunity cost was very little. And the advantage was that I saw that cycle. When I entered, I remember that Nifty was less than 1,000, Sensex was less than 3,000. Then that journey started that, okay, you could see that the markets were going up, stagnant, going up. So you could realize over a period that, you could make money, if you held on to good companies, good businesses. And slowly those kinds of things started overlapping, right? Buffett, I started reading Buffett again. Why Buffett? Because Buffett was the most easily accessible and available, content that was there. For our generation of investors, people who are, maybe in their 40s, early 40s, early 50s, Buffett was pretty much all we had. Buffett and Peter Lynch. Now, after maybe 10 years later, you get all of these other content, other styles, etc., that came up. That time, you could only get books about Buffett, Lynch and all that. So that is what you sort of overdosed on and you sort of understood what is happening.
So how did they influence your strategy at that point of time, Peter Lynch and Warren Buffett?
So the whole idea, so again, you have to understand the context at that time. I was working full time in an IT company. And here was Buffett's ideology that you buy a great company and you hold on to it. And you could see it compound and it sort of immediately gels with you, right? Okay, you buy a good company, you don't have to do a lot of effort. If you find 2-3 great companies in a period of 4-5 years, 2-3 good companies in a period of 1-2 years. So in a year, if you find 2 great companies, you invest in them, you are done. You don't have to continuously trade in, out or do whatever to make money. And that worked very well at that point in time and continues to work well. So that initial grounding of investment psychology, plus also I think more importantly what Buffett and Munger has taught me is how to live a good life. I think that is more important for me, a more important learning than their investment acumen. Because today if I look at myself after 22 years, a lot of my investment strategies or style has deviated away from what Buffett Munger has been doing. But the learning of how to live a life, how to treat people, how to interact with investors and other people, that has been a core foundational competency, if I may put it that way.
Right. Any strategy that you were following at that point of time, early in your investment career?
So the main strategy was basically pretty much close to what Buffett used to do: buy good companies. Probably the closest I would say would be a GARP kind of strategy, growth at a reasonable price. So you're looking at good companies, growing at a reasonable rate.
Right. And you're talking about next 3 years, how you're learning and growing your skills.
Yeah. So I think the learning still continues. That's been the biggest benefit of this kind of work, that you always keep learning about different things, different industries, because everything is so dynamic. Things change, and you also change over the years, right? Your thought processes, your learnings, when you reflect on what has worked for you, what is not working for you, and you incorporate that into your process, you tend to get to learn. You tend to slowly evolve your own strategy, your own theories. That, I think, is what has happened over the years. But the learning still continues. Maybe the foundational learning, what EPS means, that first couple of years was done with. But then refinement of strategies, learning new things, that keeps happening all the time.
And when did serious investing start happening?
I think I was, in terms of, if you keep aside the money part, I think I was very serious from day one. Money, slowly, I think, maybe the first decade, I would say, from 2000 to 2008, 9, 10, that period was more of accumulation, trying to build a corpus. 2010 onwards, I think, in terms of serious money, in terms of serious commitment in terms of time, effort, etc., went up manifold. Post, I think, 2000, that 8-9 period.
And how did transformation into full-time investing happen?
So 2015-16 onwards, I started feeling that, this is what I really enjoy. I'm spending so much time doing this. I love doing this. And office and work and scheduled meetings, etc., was not very attractive to me at that point in time. And so then I thought, after a while, okay, I'm making more money on when I'm doing investing. I like it much more. Why on earth should I continue doing this? It took me about a couple of years to convince my family that to leave such a MNC giant, such a big brand name, good salary. Then after a while, I think 2019, one time I just felt that it's just dragging on too much. I don't enjoy just going to office, so I just left. And then I started thinking that, okay, if I have now left and I'm going to do this full time, I have so many interests in terms of, I love reading different subjects, writing, etc., etc. So I thought, I need to do something where I will keep myself disciplined to my craft, to my skill of investing. So then I thought, okay, let me start this, research service and things like that. So I started that, and my expectation was, let me start. And as long as, there's some people who sign up, I'm okay, because at least that will help me keep being disciplined. And, I had a rough target in mind. Okay, so if I have, say, X number of people as subscribers, I'll be happy. I had more than X in the first day. So I was like, oh, okay. So now I have to really do something.
When did you found your firm?
It was 1st of April 2019.
Did people take it as a joke at that point?
No, in fact, I was thinking that, what is this? How are people signing up? And I had not put it on social media, nowhere, right? And people were just starting putting in, sending money and things like that. That time, even there was no integration with the payment gateway, etc. People was just sending money through UPI and bank transfers, and I was like, wow. So then it kept on growing, and within pretty much the first year, I had investors signing up from all continents except Antarctica. So I used to keep joking that, anybody coming from Antarctica, you get a free this thing. So people started signing up, and I thought, okay, this is good. I'm not doing anything extra for them. Whatever I'm doing for myself, I'm just formalizing it and putting it out for others. So that went on. That was the main motivation, because to keep myself disciplined. And also what I found that, for a retail investor, for small investors, getting honest advice is actually very difficult. There are so many people who are out there who either they are not they don't know what they're doing and that's a large number of people. Then a lot of people have malintent, right? Because there's so much money involved. I've seen, and we've also seen last few years in what has been happening with insider trading and those kinds of things. So I thought that, okay, if you can give people an accessible option, which is reasonably priced, which can help them in their journey. So the way I was thinking is, if somebody had given me this kind of support 20 years back, for me it would probably have been easier to become financially independent much faster than it took me. It took me probably 15-16 years. Maybe that could have been shortcut to 10 years. And for a lot of people, I think unfortunately in India or even worldwide, right, we don't teach we teach people how to earn in our colleges and schools and colleges, right? We don't teach them what to do after you earn. What will you do with your money? Nobody teaches you that. I mean, when I started my job, my dad told me, LIC kar lo and PPF mein paisa dalo. And that is what I've seen conventional. All my friends, everybody's parents told them that. So LIC was fixed, and either it was PPF or NSC or something like that. So, or bank FDs. Even today, I have some friends who put all their money in bank FDs. Right? And if you try to tell them that, boss, over a period of time, you're actually losing money because inflation is at 7-8%, you're getting 5.5%. It doesn't just get through to them because 40 years of conditioning, you cannot take it away like that.
Right.
So my thought was, okay, in this process, if I can help even, maybe 1,000, 2,000, 10,000 families, then that's a good achievement. So that was the whole, thought process.
Right. So, can you take us through the schemes that you offer?
So basically, I'll tell you what I'm doing now. We've just started a PMS. I've started a PMS with a friend of mine. So I have now two sort of engagements. One is Intelsense.in, which is the retail, the research services for typically the retail clients. And then we have Sri Rama Managers, which is our PMS. And the strategies or the thought process are the same for both. But ideally, in the research services, what we do is we focus on multiple strategies. One is obviously the long-term compounding kind of stocks. That's one where we have an outlook of 1 to 3 years. Then we have something called as hit picks. So in hit picks, what we focus on is more of techno funda bets, right? So we use technical overlay on good fundamental stocks. Holding period is roughly between 2 to 6 months. And the third is quant. Again, this is something that I and along with some of my team, we are one of the guys who have been doing this at a decent scale in India. Probably there are not too many people who are doing quant in the main scheme of things. And we use quant. Personally, I've sort of evolved into using quantamental strategies even in our long-term investing. So these are primarily our three buckets, and I have a small case specific called Quiver, which is a combination. So it's a trend following model, and where we use both techno fundas and quant as input strategies. So that's what we do. Fee structure is very nominal. We have different. Some of these services start from I think 12,000 a year. Maximum is up to 20,000 a year. The small case that we have, Quiver, it's like 2% of AUM per year. Even the PMS, I think we are, very, very reasonably priced. I think we are one of the, I would say, most competitively priced in the industry. We have a 0.9% management fee and a 9% of performance fee at the end of the year.
And what is the AUM of your PMS?
So PMS, we've just started a couple of months, so we're just in the gathering process. So just not that. The advisory side, so I also work with a couple of very large family offices. In fact, a couple of them are fairly large listed players. So I sort of advise them on their personal wealth. So overall, from our research perspective, I think we have more than 1,000 crores in terms of assets under influence. If I may put assets under influence, maybe a new term, but
Right. So it would be across small case, Intelsense,
across everything, across small case, across our research services.
Right. Now, coming to your personal portfolio, how are you invested now? And we are talking about.
See, I've always been fully invested in general. Because I've been very, very bullish on Indian markets. I think India, and I keep saying this to everyone, that if you have money, it's a criminal offense not to invest in India in equities. And if you don't have money, it's a bigger offense, because you have to get some money and you have to invest, because that is the only way out for you. So the point is that I think equities in India is in a very long-term structural bull market. We will have corrections on and off in between. Some of them will last long, maybe a year, 2 years. But our demography, our industrial growth, etc., are such that we are in a good spot for the next 10, 15, 20 years. So I am always fully invested. The only time I'm not invested fully, maybe I have some cash, is more tactical, when maybe I've sold something and I'm looking for something else, or in the shorter term portfolios, a stop loss has been hit and you get out, or you've booked profit somewhere and you're waiting to get into the next one. But in general, I like to be fully invested.
Right. And in percentage terms, when it comes to equity, debt, gold, real estate, and all.
So I don't have gold. Real estate, again, I have only one house where I stay. It's a family house, and
it's for consumption, then, not investment.
It's consumption. It's not an investment. Right. So investment, probably it's a 90-10 split. 90% equities, 10% is the money that I got from my PF and gratuity and all of that. I took that and I put it in an FD so that I get some stable cash flow. And I had a little bit more savings over the years. Stuff that I got paid out and that I've put. But I've never taken money out of my equity portfolio.
So, right. So we can broadly say equity 90% and debt 10%.
Yeah. 90-10 is a decent classification. Right. It could be, maybe 88-12 or 91. That.
Right. Got it.
Roughly 90-10 is what.
Right.
And going forward, I think it will, percentage terms, if I am able to do well, etc., the equity will go up, because debt returns will not come, equity returns will come. So going forward, it will go up from here, because I am not intending to add to my debt portfolio.
Right. So the debt is in bank FDs.
All simple bank FDs, all earning 5-6%.
Got it. Oh, in terms of performance over the past years, how has your equity portfolio performed in a CAGR terms? How would you put it?
Last 1 year or last?
You can historical since.
So historically, say last 10 years, I've been up about 20x. So that will roughly come to 35% CAGR. Last 1 year has been a little bit tough. I think last 1 year, broadly, we've been up between 20 to 25%. I have to exactly check. Across my different schemes and my personal portfolio, I think I'll be up around, right now, maybe 20%.
And debt-wise?
No clue. I mean, the debt I had never invested. I invested in 2019. And before that, it was all Provident Fund. So 8%, whatever, was in Provident Fund. And 2019 onwards, I think I have some FDs which are at 6.5%. Some are at 5.5%. So roughly maybe 5.5-6%.
So now talking about market capitalizations, how is your portfolios divided?
So completely. So I have absolutely no bias towards market cap. So I can buy micro caps to large mega caps. Okay. For example, we have stocks which have a market cap of 2,000 crores, and we have stocks which have a market cap of 2 lakh crores. So market cap is not a constraint, and we could swap. I could sell that 2 lakh crore and buy something which is 3,000 crores tomorrow. depending. So the only thing I look at is is the company good, and does it have a good next 1 to 3 year horizon. Strategy wise, see, basically the whole idea of picking a strategy is I have, like I explained, right, I have multiple strategies. So the whole idea is to use different strategies. I use a lot of quant nowadays. So quant to look at the overall market context, to look at which sectors are doing well, and most importantly, what I look for is trends. So both in business growth as well as in price, and I want both of them together, right? So that is one difference I would say that I have done over the last 10-12 years in my own investing. Previously, I was not looking for a price trend as much as I was looking for a business trend. Now I want both. I want a good business, and I want the stock price to be in a good place. I don't want to buy a stock and then hold on to it for 2 years with it doing nothing, right? Because I personally now feel that there's an opportunity cost of holding a stock, and I don't know, right? I mean, 2 years it does nothing. I keep holding. That's to me nowadays a hope investment, right? You're hoping that something will happen. At some point in time, the market needs to agree with you. So what I look for now fundamentally is I want a fundamentally good company, and I want it in a good, with a good technical chart. So good price trend and a good business and growth trend. And if I look at history, right, that is where the biggest money has been made by investors as well as by myself. So say a Bajaj Finance, I've made a decent amount of returns over the years. In the last 10 years, pretty good returns in Bajaj Finance. Why? Because the business has been in a great uptrend, and the stock price has been in a great uptrend. Right? And there are hundreds of such examples, right, where people have been making money, where the business keeps doing well, and the price of the stock keeps going up over a period of time.
How often do you churn your portfolio, or how often do you review your stocks?
So it depends on the strategy that I'm following. Like I said, we have multiple strategies. In our quant, we look at it practically every day, and we have decision points every end of the week. In our long-term portfolio, maybe the churn is like 4 or 5 stocks a year we churn. In a portfolio of between 15 to 20 stocks, we'll churn maybe 4 or 5 every year. Sometimes it may be a little bit more, sometimes a little bit less. In the HitPix kind of Technofunda portfolio, again, the churn is significant because there you're looking at a horizon of 2 to 6 months, right? So if you have, let's say, in a basket of 10 stocks, you build a portfolio, you have 10 stocks, and you're churning every, say, on an average 3 months, right? Mm-hmm. So that's in a year 4 times for one position and into 10. So 40-50 positions will anyway happen in a year in a Technofunda kind of a setup. In quant, it will be probably more. In long-term holdings, it will be very minimal. So it depends on the strategy. Our whole focus is on having style diversification. Now, what I mean by style diversification is most of the time, whenever you are interviewing other people, you will see that everybody has their own, individual single style. So, either a guy is a value investor, or somebody is a cyclical investor, or somebody is momentum, somebody is doing growth. Now, my theory, or what I have observed, is that all of these factors work only for some time in the market, right? So growth will work for some time, value will work for some time, momentum will work for some time, and then for other periods of time that strategy will not work. So what I try to do is, through myself as well as through our quant models, run different factors so that we are able to come up with multiple styles. So we run value, we run growth, we run momentum, we run all of that, and then we try to come up with a portfolio where we are incorporating a flavor of all of these. So in effect, what happens is you are getting a more smoother equity curve over a 3-year, 5-year, 10-year period. You may not get the best returns, but you will also not get the worst drawdowns, because at some point in time, one of those factors are going to work for you.
Right.
The only time it doesn't work is when it post-COVID kind of scenario, when everything falls, then nothing really works unless you're shorting the market, and we are not into FNO, so that's not something we do.
Right. So does it happen that at some point of time a single stock comes under two different types of strikes, or
Many times it happens. It happens many times that you can have a single stock which is there in the long-term portfolio also coming up in your momentum portfolio. That happens.
Right. So
now the what you have to do in those times is you have to mentally segregate those, right? So for example, let's say you have a particular stock. Just let me give you an example. Say Tata Power as an example. So Tata Power is is or was there in our long-term portfolio, and at one point in time it also came in our momentum portfolio because it was just shooting up. And once that shoot up happens, you are playing it separately. You know consciously that you are playing it as a momentum portfolio, part of momentum portfolio. So when the momentum dies off, you get out of that, but you may not get out of that stock in your long-term portfolio because you have a longer-term view of the sector, of the company, etc.
One strategy over the years that has worked for you, and one strategy that didn't work for you.
I think one, like I said, what has not worked is basically stuff where you are pinning your hopes on something changing, something so more of hope trades, right? Hope investing. So a lot of people get into this, ye ho jayega, ye change ho raha hai, this is going to happen. That has somehow not, I have not been able to do well with those. I have always believed that I will, I need to focus on what is already happening, and what is already happening and what is already visible in the numbers. Okay, so that is, I think, if we just focus on the numbers, a lot of challenges takes care of itself. A lot of people get swayed by narratives being made by either promoters or market makers, etc. But if you just focus on the numbers, that is where I think our quant models help us a lot, because it takes away the emotional content out of analysis. It lets you focus on pure numbers, and also the way it helps us is it keeps you true to the process, right? So anything, sometimes you might realize that, okay, I have made this mistake. Then your whole idea is that you go back and update your model, update your process. Whereas if you don't have a very well-defined process, what happens is you are always tending to make the same mistakes over and over again, right? But if you have a well-defined process, if you have a system, then you would incorporate your learnings over the years into your system and into your process. And I think that has helped me tremendously over the years, in terms of continuously updating my process, and now having written down processes, written down systems.
And any particular strategy or stock or sector that you bet on that didn't work out?
No. So one of the strategy, a part of my strategy or a part of my process is, if something does not work out, you have an exit plan, right? So if it doesn't work out, it's not that, you are getting into something and then you're hoping that, okay, this will work out. If it doesn't work out, either you have a price stop or you have a time stop. That, okay, this doesn't work out, in the long-term portfolio, let's say, either there's a price stop, or you say that, I will wait for 2 quarters, 3 quarters. If the results don't come up, I will exit. There's no eternal wait for hope. You're not waiting endlessly.
Right. So would you say HUL is the one stock that you waited?
Yeah. So HUL was when was 22 years back, and so the learning from HUL was this, right? That you should not be waiting. You should not just believe on quality for its own sake and brand for its own sake. Ultimately, the objective is to make money. The objective is not to hold on to marquee name stocks and then brag about it to people that see, I hold HLL, but I don't make any money out of it. The objective is to make money.
And coming to your personal portfolio, which stocks would you identify as the pillars of your wealth building?
So over the years, I think a lot of the stocks have helped me. I think Supreme Industries, Bajaj Finance, Divi's Lab, Cera Sanitary Ware, Astral Poly, Mayur Unicoaters, Ajanta Pharma, Vinati Organics, Aarti Industries. I think these have really helped me a lot over the last 10-15 years.
Right. And how many stocks do you hold in your portfolio?
Between 10 to 20, not more than 20, usually not less than 10.
And do you invest in international stocks?
A little bit on and off, not too much. The whole idea is basically to track the US tech scene. That was the whole intention. And I also, started blogging about some of these interesting US or global companies. I've not done it in a while, but now that you mention it, I'll start doing it. I was reading up a company very interesting called Lululemon.
Right.
Let me, I'll probably...
The yoga pant maker.
Yeah, and now they are diversifying into other areas, and they're doing extremely well. They've been able to build up a brand phenomenally, which is become an aspirational brand. So these are things that I keep looking at. I've been observing, watching Amazon for many years, Qualcomm, Nvidia. So a lot of these stocks I follow very closely. So yeah, I mean, US tech scene I follow very closely. Yes.
And now coming back to India, sectors that you are bullish on and sectors you are bearish on right now.
Bullish on, obviously, I think India right now, engineering capital goods looks really good. We're seeing a lot of investment related to railways, etc. Roads, railways from the government side. So that's one area looks really good. Pharma is starting to look good again. Real estate and real estate ancillaries, if I may call them that. So tiles and sanitary ware and plywood and all of those things, they look good.
Mm-hmm.
Auto ancillaries coming out again after a slump. So and obviously India always will remain a perennial play for consumption, right? Because of our demography, because of our rising aspirations. Consumption will continue to be retail focused. Businesses will continue to be there.
And bearish on?
Bearish on right now. I'm not saying I'm bearish, but I'm not very. I would say I'm slightly bearish on IT right now. It will take time for IT to turn around, in my opinion. Except maybe a select companies, maybe 1 or 2 or 3 companies might do well. But in general, I think IT is going to be in a tough spot for some time. Other than IT, what else? Not too much, not too bearish, honestly speaking. More, I think, if I may put it this way, that I'm bullish on the India specific themes where consumption is internal. Export-oriented themes, I am slightly more skeptical about, because globally things are not looking as good as it was, say, a year, 2 years, or 5 years back.
Right. So now coming to some personal finance details, Abhishek, how many months of emergency fund do you provision for?
I don't have any emergency funds. All that FD that is there, if it is required, I'll use them. But main idea is, we have that middle class ethos, right? And what is a typical emergency for a middle class family? It's medical emergency. Pretty much. That's the only thing that I can think of. And we have medical insurance coverage. Other than that, I don't see any emergency as such in terms of, what could be an emergency. I mean, I might lose people might think that you're going to a job loss. I don't have a job, so no paycheck coming in, so nothing much. Honestly.
So you have both.
That those FDs are what is there. If it is required, I'll take money out.
Okay. And you talked about insurance. So you have both life insurance and health insurance?
So life insurance is, I mean, when I started off, I had some. I've not added any anymore. And medical insurance I have, for our family. Yes.
So life is pure term or LIC policies?
First few were LIC policies. That was the age of ignorance. Didn't know any better. Then I had a term plan. I think right now I don't have too much of life insurance. The old ones that are there. Last 10-15 years, I don't think I've taken any insurance.
Okay.
Again, I mean, the logic of an insurance policy, life insurance is, it should be an income replacement, right?
Right.
Now, for somebody who does not have a job which gives him a cash flow, what is the income replacement required?
Yes.
My spouse works, she has a government job. So income replacement is not required. And even if I die, they will have the same kind of lifestyle.
And were you able to go on a holiday in the past year?
Yeah. So we are Bengalis, right? I mean, every month, 2 months, 3 months, we'll go somewhere.
Okay. So
post-COVID, I think we've been, we've gone to places where it's, drivable in general. So not long vacations, but close by. Maybe I think we went to. So I went to Bangalore a few days back, but that was more for work than for vacation. We went to North Bengal some time back. We went to Mandarmani, we went to Murshidabad, Shanti Niketan. So a lot of these small trips we could do.
Any lifestyle change that you picked up during the lockdown and which will become permanent now?
Yeah, watching OTT here. I mean, now I think going to a cinema theater. I love movies. I just watch a lot of movies, web series, whatever. But the propensity of going to a theater now has reduced. I think more comfortable watching on OTT.
Okay. And the last two questions. First is, what does wealth mean to you?
Basically, wealth means freedom of time. Nothing more than that. It's freedom of time. You can do whatever you want at the time that you want.
Got it. And how do you identify yourself as an investor?
Someone who keeps learning and evolving to improve. I think forever exploring new things.
Abhishek, that's it from my side. It was a pleasure talking to you.
Same here.
That's it for today. If you have any questions, you can write to us at mintmoney@livemint.com. If you want me to cover any specific topic, DM me at Abhinav Kaul at Twitter. To stay updated on this podcast, follow HT Smartcast on Facebook, Instagram, Twitter, YouTube and LinkedIn. To listen to more such podcasts, log into htsmartcast.com और सुनो नए नजरिए से.
This was a Mint production brought to you by HT Smartcast.
HT Smartcast.